Hello everyone, Professor Watts here, and this week we're going to learn about the balance of payments, very important topic in international trade and international finance. I want to motivate our discussion today with this question, often controversial topic of trade deficits. Should we worry about trade deficits? Let's listen to what our former president had to say on this issue.
We have a massive trade deficit, out of control trade deficit. Our trade deficit is massive.
Donald Trump loves to talk about the U.S. trade deficit.
The jobs and wealth have been stripped from our country. Year after year, decade after decade, trade deficit upon trade deficit.
It's been a near constant target for him, both on the campaign trail and in the White House.
The president is unfortunately rather obsessed.
That's Scott Lincicome. He's a trade lawyer. We'll get back to him in a second. But first, what exactly is the trade deficit?
So this is fairly simple. Countries are constantly trading with one another, but it's not always one for one. When a country imports more than it exports, it has a trade deficit. And when it exports more than it imports, it has a trade surplus.
So how is America doing on trade?
Right now, we have foolish trade. We have, ready? We have stupid trade, stupid trade.
In 2017, the US had imports totaling $2.9 trillion, but it only exported $2.3 trillion. Do the math, and that's a $566 billion trade deficit, or an increase of 12.1% during Trump's first year in office.
So that's bad, right?
There are very few economists that would argue that that number really means anything. Here in the United States, because we consume and invest more than we save, we are going to run a trade deficit. Also, because foreign investors find the United States to be a very attractive place to invest, there's more foreign investment coming in. There is not just this giant sucking sound of money leaving the country and never coming back.
It's a chronic drag on growth and a destroyer of jobs and the wealth of our country.
But hold on one second. The US has also seen a massive decrease in manufacturing jobs in recent decades, and it hasn't just been Donald Trump raising the alarm about trade.
Disastrous trade policies.
The big driver of manufacturing job losses is technology. Massive advancements in robotics and information technology and so forth.
Made in the USA is a big deal now. We're bringing it back.
Trade and globalization certainly create new competitive pressures, and import competition will end up causing job losses, but that is a very small share compared to technology and automation.
So as that news clip noted, President Trump and other politicians, and not just politicians on the right but on the left as well, have been for decades really concerned about the trade deficit and what they think the implications of that are for the US economy. But like most economists, I'm here to tell you that trade deficits are not usually something to worry about. So in this video we're going to learn about what trade deficit or trade surplus means. We're going to learn about trade accounting, and then we're going to work through an accounting system called the International Balance of Payments to see why all of this matters. Okay, so let me start by saying trade deficits are common. Let me give myself as an example. I have a persistent and chronic trade deficit with one of my favorite restaurants, Culver's. I go there often. I give them money. They give me cheeseburgers. Okay? Never have I sold anything to Culver's. I've never worked there. They've never given me any money. Okay, so I have a steady, persistent outflow of money going to Culver's, probably hundreds of dollars per year. And all I'm doing vis-a-vis Culver's is consuming their products, not selling them anything. Trade deficit, right? I'm importing more products from them, namely cheeseburgers and fries and root beer as well, and sometimes custard. And I'm exporting nothing to them in return. I'm just handing them money. You probably have the same situation with all manner of businesses that you buy from. You're running a trade deficit, what we would technically call a merchandise trade deficit, with all the businesses you buy from. The grocery store, the gas station, Amazon.com, and what have you. Now, the question is, how do we finance this? How is this viable? How is this sustainable? Well, we finance these merchandise trade deficits by running what's known as a financial surplus with another entity. So why am I able to just shell money out to the tune of hundreds of dollars a year with Culver's and thousands of dollars a year if you think about all the businesses I buy from? Well, it's because I have a financial surplus, namely with the entity or business I work for. Okay, so on the flip side, I have a trade surplus with Ferris State. I export to them teaching services. and they pay me money, lots of money. And I buy little to no goods from them in return. So all I do vis-a-vis fair estate is export. I don't import anything from them. Occasionally I'll go over and have lunch at the Rock, so there might be a little tiny amount of imports, but it's pretty much a one-way transaction. So I have a trade surplus with fair estate, and that enables me to finance the trade deficits I run with all those other businesses that I buy from. This is going to be the same for each of us. So on an individual level, we have trade deficits, we have trade surpluses. What does any of this mean? Well, really nothing. Okay, so at an individual level, this kind of accounting isn't that useful. What I'm interested in when I'm assessing my financial health might be something like, what's my net worth? Am I saving enough of my income to finance my future? What's my debt to income ratio? And that kind of thing. Okay, now we'll apply these similar concepts to nations, and we'll see that in reality it's not really that different. But first I want to take a step back and say, okay, what are we trying to focus on? What are we trying to learn about in this unit, in this chapter? So I devised 3 major themes with respect to the balance of payments, and we'll kind of work through the implications of these here as we go. Number 1, everyone runs deficits with some and surpluses with others. So this is true at an individual level and is true at the national level. 2, having a deficit or surplus with another entity, whether you're an individual or an entire country, is not necessarily bad or good per se in itself. It might matter how and why you got there, but even then it could be ambiguous. And then finally, the balance of payments must balance. So if you have a trade deficit, you have to have what we call a capital surplus or a financial surplus. You could have an adjustment in your assets, but the balance must balance. And when people talk about the trade deficits, they're only talking about one part, really one half of a larger equation. And that's why we talk about balance of payments here and not just trade deficits or trade surpluses. We're going to look at the entire picture. Okay, so here's what we're going to get into in detail. Balance of payments accounting. That involves 4 accounts and then a statistical discrepancy, because when we're dealing with numbers this big and collecting real world data on the largest economies in the world, we're not always going to be exactly correct. But there's basically 4 accounts that we have to consider. Okay, then we'll look at the equation or the identity for balance of payments. We'll think about the math of balance of payments for countries. And then we'll look at some balance of payments trends for major countries. So President Trump there talked about the fact that the U.S. is running trade deficits with China. What does that mean? Well, what's happening with China? What's happening with some other major countries? And what does that mean, if anything? Okay, so let's jump into balance of payments accounting. Balance of payments is just the statistical record, the data of a country's international transactions over a certain time period. And we're going to do this with double entry bookkeeping. So as you hopefully know from your basic accounting classes, for every debit there is an equal and opposite credit. Okay, so let's talk a little bit more about this bookkeeping. Any money received from a foreign country is going to be recorded as a credit, a plus, in the U.S. balance of payments. So when the U.S. sells goods to foreign countries, goods and services, receives financial claims or real assets. So when money pours into the United States, either to buy our products and services or to purchase assets. So foreign individuals might buy land or houses in the United States. Foreign businesses might acquire companies in the United States or shares of companies in the United States. All of those things would be credits in our balance of payments. Likewise, payments going out to foreigners from the U.S. will be recorded as debits, minus sign, in our balance of payments. So when we import foreign goods and services, or when Americans go out and buy stock in foreign companies or buy land in another country, if an American expatriate, for example, goes and buys a little estate in Central America, okay, that's going to be a debit in our balance of payments. Now, as we mentioned, there are 4 main categories for balance of payments accounting. The current account, that's the export and import of goods and services. Sometimes goods are referred to as merchandise, so when you buy clothing that comes in from China, let's say, or electronics that comes in from China or Asia, the United States exports a lot of things like machinery, farm products, raw materials, petrochemicals. Now the U.S. became a net energy exporter a few years ago. Services would be a lot of things like business services. Tourism, when people come and spend money in the United States, but they're just tourists visiting here, then they go home to a foreign country, that is technically an export of a service. Foreign students coming to the United States to study, we're technically exporting educational services. So you want to think broadly about what's included here. It's not just physical products, of course. Okay, then we've got the capital account. Now, this book is a little unique in the way they express this. Most people, when they talk about the capital account, they mean something else, and we'll cover that here momentarily. But this book uses a separate definition for the capital account. And they're talking about a really narrow area of capital transfers and cross-border acquisition of non-produced financial assets, so something like land. So overall, in foreign exchange markets and international trade and balance of payments accounting, this one's pretty minor, so we don't have to spend too much time on it. Now, the financial account is going to be very important. And I just want to note here that most other sources I've seen, and actually I'm going to post a few supplemental videos, background videos along with this lecture. When you hear people there talking about the capital account, what they mean is what our book is calling the financial account. So might be worth kind of putting that in parentheses there. So that's all purchases and sales of financial assets, stocks, bonds, bank accounts. Okay, when a foreign company puts money into a bank account in the United States, that is going to increase the United States financial account. When a foreign individual buys stock in a U.S. company, that increases United States financial account. Foreign central bank buys U.S. government bonds because they'd have nothing else to do with the dollars they've earned by having a merchandise surplus, trade surplus with the United States. That's going to increase our country's financial account. Okay, then there's official reserves, which covers exchanges of international reserve assets. Well, what the heck does that mean? Well, that's mainly going to be foreign currency. I'll give you some examples of how that plays out here momentarily. Okay, so let's look at the U.S. balance of payment situation for 2018, for the year for which the book has the latest data available. This is in billions, so the U.S. has total exports of $2.5 trillion. It's not too shabby, of which $1.67 trillion is exports of goods, and then $800 billion roughly is exports of services. So don't believe it if people say the U.S. doesn't export anything. The U.S. has tremendous exports. The only thing is that our imports are a little bit bigger. So our goods imports are $2.5 trillion, and then our services imports are another about $0.5 trillion. So our total imports are $3 trillion. If our total exports are $2.5 trillion and our total imports are $3 trillion, well then yes, of course, we are running a, quote, trade deficit of something on the order of $500 billion. It's actually closer to $600 billion here. I'm just kind of rounding these off. So we have a trade deficit of $500 billion. Well, what does that mean? Well, look at the remainder of our balance of payments accounts and you'll see what's happening. So we also earn income from abroad. That's divided into primary and secondary income. So the United States earned about $1 trillion. This is mostly going to be U.S. businesses operating in foreign countries and earning money there, which they can choose to bring back to the United States or they can hold it overseas. In like manner, we have foreign businesses earning money in the U.S. Okay? Secondary income is going to mostly be transfer payments. So the U.S. government spends some money abroad. Some money comes into the United States from foreign entities. A lot more goes out, mostly from the U.S. government to foreign entities. Right, so here we wind up with our balance on our current account. The technical value here is $488 billion. All right, but now let's look at the capital and financial accounts. So capital account here is very small, a little bit of money flowing into the U.S., almost nothing flowing out. What we're really interested in is the financial account. And that is going to be broken down into a few different kinds of investment. Direct investment, companies purchasing assets, building factories, setting up logistics and marketing and supply chains in foreign countries. Well, we had an inflow of $267 billion in foreign direct investment into the United States. Portfolio investment. This is where could be foreign companies, foreign citizens, foreign governments purchasing portfolio securities like stocks and bonds in the United States. So purchasing shares of U.S. companies, purchasing government bonds, purchasing corporate bonds. We had a significant inflow in each of these categories. Money coming in across the board here is higher than the money that's going out. Okay, and then other miscellaneous investments, again, much more is coming in that is going out. So what we have with our balance on the financial account, you'll notice, is going to be positive 500 billion, and that's going to roughly offset the balance on the current account, which is roughly negative 500 billion. Of course, those aren't going to be exactly equal, something called a statistical discrepancy. There's a $40 billion difference basically in all of our current account data relative to all of our financial account data. So this is just a accounting entry that offsets those statistical discrepancies. Okay, we do wind up with a very small net overall difference even after the statistical discrepancy. So that's going to be balanced out by having a small change in official reserves. But for now, what we want to take a look at is this broad overall fact that whatever's going on in the current account is, roughly speaking, going to be balanced out by whatever's going on in the financial account. So if you have a trade deficit up here, a current account deficit, you're going to have a capital account surplus. Vice versa. If you have a current account surplus, a trade surplus, you're likely going to have a financial account deficit. There are some exceptions to that, but that's a pattern that's very strong. Any discrepancies between that offset between the current account and the financial account are going to be met with by changes in the official reserve. So the total accounts will always balance. As I said before, the balance of payments will always balance in the end. Okay, now we'll talk about the math here, the balance of payments identity. And that just means that the balance of those four accounts has to balance out to zero. Balance of the current account plus the balance of the capital account. Why did it use K here? Because C is going to be used for current. Plus the balance of the financial account plus the balance of reserve assets. Okay. So the changes in all of those things have to equal up to zero. Remember what I said earlier, the balance of payments always balances. And so you got the current account, capital account, financial account, and a reserves account. Now, as I mentioned before, we're not going to really focus on capital account. It's pretty insignificant. So we're going to focus on current account, financial account, which remember, a lot of other sources call this one the capital account, and then your official reserve. So when we think about what's happening with countries, the action is typically going to be between the current and financial account, and then occasionally with changes in official reserves. Okay, so I want to walk you through a couple of scenarios, and then we'll look at the data, and this will be roughly descriptive of the major patterns we see with actual countries in recent history, the last several decades. You can have a current account deficit and a financial account surplus. Very common. This is exemplary of the United States for the past roughly 3 decades. We have a trade deficit. You know, we saw President Trump and other politicians harping about that. We're importing more than we're exporting. Oh my goodness, how does that happen? Well, it's because we have a financial account surplus. Basically, when you're importing more than you're exporting, that means you're sending more of your money abroad than the foreigners are sending that money back to purchase your products. So what are they doing with the extra money that they get from selling you stuff that they don't turn around and then buy stuff from you? Well, they take that extra money and they, instead of buying products, invest it in your country's assets. So they buy stocks and bonds and do foreign direct investment and that kind of thing. And as we discussed, we looked at the data, this is pretty much exactly the situation for the United States for the past several decades. The U.S. offsets its current account deficits with financial account surpluses almost on a one-to-one basis. Might be some small changes in official reserves here and there, but this is almost one-to-one for the United States. So classic example of one of the few scenarios that are possible to make balance of payments balance. Okay, here's another one. As I mentioned also, you could have a current account deficit and a drawdown of foreign exchange reserves. So here now we're going to put the reserve account on the other side of the equation, and note that if you have a current account deficit, so negative balance on the current account, you're going to have a decline in reserve assets to match that. The textbook talks about in chapter 3, this was the case with Mexico in the early to mid 1990s, and they actually had such persistent current account deficits and significant enough decline in their foreign exchange reserves that they had to go ahead and depreciate. They had to devalue their currency. This is true for fixed exchange rate countries, remember. Flexible exchange rate countries that run persistent current account deficits and they don't see an offsetting financial account surplus, well, they will just see their currencies depreciate in foreign exchange markets. And the reason for that, if you think about it, these countries are buying more in international trade than they're selling. They're supplying a lot more of their own currency in order to buy imports than they are earning back through exports. So if the supply of their currencies goes up without a countervailing increase in demand, the value of their currency has to go down. So flexible exchange rate countries will see the adjustment mechanism happen through exchange rates. Fixed exchange rate countries, like Mexico was, pegging to the US dollar back in the early 1990s, couldn't sustain that forever, so they had to have that drawdown of foreign exchange reserve. Okay, let's flip the United States around. We had a current account deficit and financial account surplus. Some countries have a current account surplus offset by a financial account deficit. So countries sell more products abroad than they import from abroad. That means they have a positive current account, trade surplus. That also means they have net earnings in foreign trade. Now, what do they do with those earnings? Well, a lot of times they'll take those earnings and invest them back in the countries where they had the trade surpluses with. So, as an example here would be China. For much of the past several decades, although there, as I mentioned, there were a few episodes where China had both a current account and a financial account surplus, then that was offset by a massive increase in official reserves. And that's a final example here. So if you could have a current account surplus and finance that by just accumulating foreign exchange reserves. You could also, like I was just saying about China, have both a current account surplus and a financial account surplus, and then you just have an even larger accumulation of foreign exchange reserves right here. So this is China in a few of the recent years. We'll look at the data here momentarily. This is China for most of the last few decades. A few of the years they had this particular situation. Okay, so that brings us to the data, and we'll wrap up here by looking at some major countries and where they are basically in this system. All right, so the U.S. has had continuous, persistent current account deficits / financial account surpluses since about the early 1980s. So we're going on 40 years of that scenario. You know, we could call it a trade deficit if you want, but to be complete, you should also call it a financial account surplus. Now, these are big, and some people do worry about this. We'll watch some other supplementary videos where we'll see why some people are concerned about this. Japan, on the other hand, had current account surpluses and financial account deficits, so they're the flip side of the United States, roughly for the same time period, even though they did see currency appreciation early in that time period. Does that mean Japan's economy was in fundamentally better shape than the United States economy during that time period? No, absolutely not. In fact, Japan suffered a major recession in the 1990s. They suffered years of declining economy and deflation. It's called the Japan's lost decade. Their economy is growing pretty sluggishly today. So it's not necessarily a good thing to have trade surpluses. It depends what else is happening in your economy. And it's not necessarily a bad thing to have trade deficits. It depends what else is happening in your economy. All right, we could look at Europe. UK, kind of like the United States, typical running current account deficits / financial account surpluses, although on a far smaller scale. Germany, a little bit more like Japan. Current account surpluses, financial account deficits. Although there was a decade there where they had current account deficits due to the situation involving German reunification after the end of the Cold War. China, as we mentioned, tends to run a surplus in the current account and the financial account until recently, where they're back to current account surplus, financial account deficits. Do we have a global imbalance? Well, yes, but it's kind of the implication of that depends on what do we mean by imbalance. On a surface level, it's just an accounting imbalance. Some people earn more than they spend. That's an imbalance, right? Well, those people take the net difference and save it and invest it. And then that helps some other people spend more than they earn. Now, is it bad to spend more than you earn? Well, we have to say it depends why. If you're borrowing money to wisely invest either in building a business or attaining an education, building assets, building skills that will make you more productive and earn more income in the future, well, then it's perfectly sensible to spend more than you earn, at least for a time. So again, it depends on what else is happening in your economy, and there's different views on this. I don't want to be too sanguine about the idea that trade deficits don't matter, but I do generally fall in the camp personally of you can't really infer what's going on in an economy and whether the economy's in good or bad shape just on the basis of a trade deficit. You have to look at a much larger picture. Let's wrap up by looking at some data on this. Here's our top trading partners for 2018, and you can see whether the U.S. is running a surplus or deficit. You know, there's a lot of talk about China. Of course, China's the biggest trading partner. It's a massive industrializing economy, and they do supply us with a lot of products. We import $540 billion from China and only sell $120 billion to them. So the bulk of our merchandise trade deficit is indeed with China. Okay, if you look at our next trading partners, though, Canada and Mexico combined are bigger than China, and it's much closer to balance. So there's roughly even flow of goods both ways from the U.S. to Canada, 318 billion in imports, almost 300 billion in exports. Same thing with Mexico, a little bit of a gap there, but much more U.S. products going to Mexico actually than going to China. Makes sense, they're right across the border. It's transportation costs are much lower. Okay, then we've got a few other significant trading partners. We've got some countries that we're running trade, current account, merchandise, trade surpluses with. Not super common, but you want to have a nuanced understanding of what's going on here. It's not just China. China's the biggest trading partner, but if you take all of our other trading partners and add them up, they would actually dwarf China. So it's not just a story about China. Let's finally jump into the textbook, and I want to look at these balance of payments trends in major countries. This is going back to the early 1980s, so we got about a 40-year track record here. Okay, we'll look at the United States over here on the right column. Current account, financial account. Here's the thing, let's look up here to more recent data. So look at the past several years. This one goes to 2017, and there's only one thing I want you to observe here. Yeah, we have large current account deficits, but notice we also have almost exactly the same magnitude of financial account surpluses. In fact, in some years it is just almost exactly identical. So here in 07, we had a $710 billion current account deficit, but we had a $710 billion financial account surplus. Same thing for almost every year. So our trade deficits, our current account deficits, are usually almost exactly offset by the financial account or capital account surpluses. Almost one-to-one. Look at 2017, 424 billion deficit, 423 billion surplus. Okay, so current account deficits usually imply financial account surpluses. We did note, though, China had some years here, kind of in the 2000s, where they were running both a current account surplus and a financial account surplus. So let's look at like 2010 here for China. They had a net trade surplus of 242 billion. Then they also had a net financial surplus of 230 billion. Well, what was going on for them there? Well, they would have accumulated roughly 470 billion or so in foreign exchange assets, and they did. They built up their foreign exchange reserves to just tremendously large levels during the time period when they were running both current account and financial account surpluses that were over about maybe a 10-year period there. Recently, China has emerged as kind of the flip side of the United States. So you can see in the past several years here, when China runs a current account surplus, they're running a corresponding financial account deficit. And in some cases, their financial account deficit is larger than their current account surplus, which means that they are going to see an outflow of foreign exchange reserve. Right? The balance of payments has to balance. One more quick thing we'll look at here. If we look at the chart of our financial account and our current account, you'll see that it's almost a mirror image of each other. So whenever we have a current account deficit, which again we've had since, with almost without exception, since the early 1980s, we've got an almost exactly offsetting financial account surplus. Balance of payments balance, current account deficits are balanced by financial account surpluses, typically speaking. That could also be balanced by changes in official reserves. China's situation is a little different, not a mirror image. Remember, China story there is much more a story of changes in their reserve assets or holdings of foreign currency. Okay, so that summarizes this balance of payments concept. I hope it makes more sense to you now than it did before. Please take a look at those supplemental background videos that I posted in this unit as well. And I look forward to talking to you again next week as we wrap up Unit 1.